Most people think economists are experts on money because, of course, that's what economics is all about. But if you study economics, you learn that conventional macroeconomic models leave out the existence of banks, debt and money in modelling the economy. So much so that they actually find it strange when somebody like myself argues that banks, debt and money must be included in modelling the macroeconomy. So here's a classic statement from Keen-Krugman on this front when he was critiquing a paper of mine some years ago, and says that I assert that putting banks in the story of how the economy operates is essential. And he states, well, quite a bit of incredulity here. He's all for including the banking sector in stories where it's relevant, but why is it so crucial to a story about debt and leverage? And then goes on to say that I argue that once you include banks lending and in the system, lending increases the money supply. He says, well, why does that matter? And but I must be assuming that the turnover of money remains constant, etc., etc. So you can see that there's quite a bit of outright incredulity from the world's leading economist, conventional economist, in why I argue that we should be including the banking sector in the economy. So what I want to do in this video is take the rather more advanced model of how a debt deflation occurs that Krugman put together in a technical paper with Egerton, and put that vision they have of the role of banks as simply as intermediaries rather than having any real originating impact on the economy, put that model into my software package called Minsky, and then show what happens when I give banks an active role in the economy by making a few very simple changes to that model. I'm going to do this slowly. I'm going to, in some parts I'll race through using video tricks to build the model rapidly, but in the section where I'm laying out the logic, I'll go as slowly as possible so you can follow what I'm doing, and of course I'll save these files for people to download from my blog. To support the arguments that Krugman made when he was criticising me for arguing we must include banks and debt and money in the model of macroeconomics, he was basing a lot of his argument on this technical paper he wrote with Gauti Egerton, where they introduced debt, but not banks and not money, into a standard neoclassical dynamic stochastic general equilibrium model, and then explain how debt had a role. So they talk about, first of all, saying that if there's a single word that appears most frequently in discussions of the crisis, that word is surely debt, and then go on further to say that, somewhat surprisingly, it is quite common to abstract altogether from this feature of the economy. In other words, acknowledging that conventional economists, including themselves, have not previously included debt or banks or money in the model they make of the macroeconomy. Now, in this particular paper, all they had was one patient agent lending to an impatient agent. But in an appendix which developed the paper in rather more detail, they added the existence of a banking sector playing the role that banks are seen as playing in conventional economic theory, which is the role of being intermediaries. So they exist, but all they do is they enable more easily a person who has money they've saved, they wish to lend out and make an interest rate return on, lend that to another person who wishes to borrow, and the bank then makes a profit by charging a fee for being an intermediator. So that model turns up later in this paper, where they bring in the banking sector as being a type of agent that accepts deposits from some anonymous depositor and lends them to another individual and then charges a fee for doing that. And just to cover a bit more detail on what they do with this particular paper, I get about the mathematics here. Of course it gets to be quite complicated, but they end up having the lending being between a agent that produces consumption goods lending to an agent that produces investment goods. Now what I'm going to do in this video is take that basic structure of the consumption sector, as I'll call it, lending to the investment sector through a banking sector which is just a pure intermediator. So the consumer sector will deposit money in the banking sector. That then creates reserves that are an asset of the bank, matched by the liability of that deposit that the consumer sector has made, and then the consumer sector will lend to the investment sector, and the bank, which implicitly arranged that loan, charges an intermediation fee to the consumer sector, and then both consumption sector and the investment sector hire workers and produce output, and then both the workers and the bank and also the investment sector purchase goods from the consumer sector, and the consumer sector purchases goods from the investment sector. So I'll build up a monetary model like that where banks just are simply pure intermediaries and show how that behaves, and see whether that correlates to the argument that Krugman makes that you don't need to include banks or money in the model of the macroeconomy. You can get away with modeling even the crisis as big as the 2007-2008 crash just by including the fact that debt is in the system, which is the thing they had to add to their models previously that wasn't there. But you don't need to include banks and money. Let's see how that works when I put it together in Minsky. So here you go, modeling that system in Minsky. So the first thing I do is create a banking icon and right click on it and choose to open the table and see this double entry view of the financial system seen from the point of view of a particular agent, and this agent we're going to have as the banking sector. Now, of course, as I mentioned beforehand, the vision that Krugman and Egerton have is of a consumer sector depositing money at the bank, which is then lent out to the investment sector, with the banking sector operating as an intermediary. So when that money is deposited, of course, it becomes a reserve of the bank. So I'm going to create an asset class here and call that reserves. And we now have to have the deposits of the investment sector and the consumption sector, which are liabilities of the bank. So I choose these to be liabilities, and I'll call the first one dep underscore consumption, CON for consumption, and the second one DEP for deposit underscore INV for investment. Notice that these are now turning up as elements coming out the bottom of the banking icon in Minsky down here, and both workers and both the consumption sector and the investment sector have to hire workers. And then finally, the bank ends up making some money out of this whole procedure, so it has some equity, and I'll call this the bank's net worth. Now, the system starts with an initial deposit, so if the consumer sector makes a deposit of $100 in the bank, then that is shown as a reserve, which is a positive asset for the bank, but that also gives them a liability to the consumer sector. They have to pay that $100 back if the consumer sector asked for it. So the convention we use in Minsky is to show both deposits and also show liabilities and equity as negative sums, the assets as positive sums, and therefore enforce strict accounting correctly by requiring that all rows, including the initial conditions, sum to zero. Now, having done that, I've now got the initial amount of money in the system. What I want to now show is the lending of money. So we have, this is just a label to say what this particular row describes, and the loan is going to be lending of money. I'll call this the flow of lend from the consumer sector to the investment sector. Now, we're using convention here that flows start from a positive and end in a negative, a bit like the way that electrical engineers model the flow of electricity, even though we know it goes with the opposite direction in the sign of electrons, but nonetheless it goes from positive to negative. We're using the same convention here. So the positive is the from, the negative is the to. That might look strange when you see it this way because it looks like money's added to the consumer sector and taken out of it. It's just a convention that makes it easy to look at the very complex system, as you'll see when I bring in other views on the financial system, seeing it from the point of view of the consumer sector and the investment sector. You can, if you wish to work as an accountant, change across to seeing this way the accountants see it, which is by having debit and credit shown for those entries rather than plus and minus. I find it easier to work with the plus and minus, so I'll stick with that. Okay, that's the very first operation, the lending of money. Of course, once you've lent money, then you have to pay interest. So that is a payment of the flow of int from the investment sector to the consumption sector. And the program does the checking to make sure that sums to zero. Then you have the potential to repay the debt. That's going to be a flow also from the investment sector to the consumption sector. And the bank is doing this to get an intermediation fee. So I'm going to call this int underscore fee. That's of course paid by the consumption sector because they're the one That's the ones that are getting the money from making the loan, and that ends up going across to the bank, which means the bank gets some money that they can therefore use in transactions in the system. Now, having done that, I'm going to add other rows for the standard transactions one has to have in an economy, for example, hiring workers. To hire workers, you must pay a wage, and I'll make this hiring workers by the consumption sector first of all. So I'm going to call this the flow wages underscore C. Notice as I'm doing this, by the way, that all these various elements are turning up in the bank icon itself. Now that I haven't finished balancing this out, I've got to show where this flow ends up going. Of course, it goes into the accounts of the workers, so we now have minus wages C turning up there. And then the investment goods sector also hires workers, so they have to pay wages as well. Once this is all done, there is now consumption by the workers, and that of course is a payment to the consumer sector. Consumption by the bankers. This is just a label over here, by the way. Doesn't actually become part of the... no, notice what I've done here wrong. I'm rather pleased I've done that. I forgot to type the minus at the beginning of this element here, so the program is telling me I've got 2 times consumption there. That row is not balanced. So I click here and hold down the control key and move one character at a time. I can go across here and type the minus, and now that row is correct. Okay, consumption by the banking sector is a flow from there to the consumer sector, and I'm going to have the consumer sector buying investment goods. So that's going to be a flow from here, and I'll call this INV underscore C for investment by the consumption sector. And the investment sector buying consumption goods, and that's going to be a flow from the investment sector to the consumer sector. So those are all the flows I need to find a very extremely stylized, a simple monetary model, which is putting into Minsky the vision of banks being intermediaries, that is the way that they're seen in conventional macro modeling, and therefore ignored because they have no real impact upon the level of output of the economy, and so on. Okay, that's to find that. Now I'll now show you one reason why it's useful to use this convention Minsky has of showing liabilities as negatives and assets as positive, because what I've shown you there in this table is the view of the system from the point of view of the bank alone. But notice I've got lending and interest and repayments going on, but I haven't stated where the loan is. Well, that's because in this model the loan is an asset of the consumer sector. So I now want to include the consumer sector in the model, and to do that I put in another Godley table, named after Wynne Godley, by the way, for those who don't know the history of post-Keynesian economic thought. Okay, this is the consumer sector, and I now want to define its assets and liabilities, so I click on Asset here. Now this drop-down menu here will show me available assets that haven't been assigned to other Godley tables in the system. And there I have the deposit of the consumer sector. So I'm going to click on that, and as soon as I do, all the activity I've currently put on the table for the banking sector's view, which I'll just bring back up here, is instantly transferred down here. And what Minsky is now prompting me to do is to add in the liabilities and the assets I need to make this all balanced, because at the moment all these elements don't have matching entries that bring the whole thing to zero. So I click here, and I'm now going to create another asset, which of course is the loan. And showing what's happening here, well, lending increases the value of that asset, and now that row sums to zero. Repayment reduces it. Now you can see why we use that convention of positives and negatives. The interest payment is not going to come out of the loan itself. We now have to consider either the liabilities or the equity of the consumer sector, and as the lender, the sole lender in the model, the consumer sector doesn't have any liabilities, so we'd have to look at its equity instead, and I'll call this CONS_NW for net worth, just the same approach I used for the bank up there. And of course the interest payments are going to be increasing their equity, so I'll use minus in to show that's a flow from the payment by the consumption sector across to the consumer sector. In the opposite direction, the payment of the fee takes money out, makes money out of the equity of the consumer sector. The payment, and then all the other payments here end up increasing. Actually, wages are also a payment out, so I make this wages, pay wages out of their net worth, and then the payments by the consumer sector and the investment sector and the workers a flow in, and finally this is a flow out of purchasing investment goods. Now that's balanced the table completely for the consumer sector, except that I haven't shown their net worth. Well, that net worth started at 100 because that was what they deposited in the bank. So I've now got the economy being seen from the point of view of two sets of agents, the banking sector and the consumer sector, and I'll now cheat and speed up a bit and bring in the investment and the workers sector if I speed the video to save time, but of course doing the same procedures for them. So let's just save this first of all. Now, I've shown them this is now starting to do the investment sector, and I need to show that it's got a liability. What are the available liabilities? That includes loans. Notice reserves there are too, so I'd include what happens with the government sector if I extended to include a government sector as well. As soon as I type loans that are a liability of the investment sector, then the operations that are relevant to that are inserted by the program. So I've got those two balanced out, and I now need to look at the net worth of the investment sector. So I'll do that and then do the high-speed routine so you don't have to watch me doing all that in detail. I'll fill in the other entries. Right, this is now a complete view of the model of the economy, where I've just got the flows defined verbally. I haven't actually put equations in there as yet, and that's what I'll do in the next part of the video. But just to show you the overall system, I have lending between the consumer sector and the investment sector, patient and impatient in the original simpler Endogenous and Krugman model, interest payments, repayment of debt, payment of the intermediation fee, paying out wages to workers, consumption by each of the social classes of the other social classes in the system, and this is all balanced across the vision of the banking sector from the banking sector's point of view, from the consumer sector's point of view, the investment sector, and finally the workers. And looking back on the overall canvas, I now have these four banking icons that give me this fairly complete vision of a private sector economy where banks are just intermediaries. And at the next stage of the model is to start adding definitions for things like the rate of payment on interest. What I've defined so far is just the structure of flows between different entities in the system for different reasons. So consumption flow from the bankers goes from the bankers to the consumer sector and so on. But I haven't given any numerical values yet. The way I do that in Minsky is by moving my mouse until it's over one of these flow objects or account objects here. You'll see the little circles appear on them as well. If I right click, I can choose copy and copy that flow down here, and now I can define that flow. Well, the level of interest payments is going to be proportional to the level of loans. So I copy loans and bring that down here, and I need to multiply loans by the rate of interest. I can just type on the canvas directly and type R_L and press the enter key, and that creates a variable called the rate of interest, RL, for a rate of interest on loans. Press the multiply key, and I've now got a multiply function there. And now if I bring my cursor up here, you'll see the little circles turning up. When that circle turns up, I can drag from that circle to the input of another element, and I've now defined an equation saying interest payments are equal to the rate of interest multiplied by the level of loans. So I'm going to do the same thing for all the other elements of the flows in the system as well, and I'm going to use a convention in system dynamics of using what are called time constants. Now, these are variable, in fact you can change the value of them, but I'm going to say, for example, that the level of consumption by workers is a function of time constant, which tells you how often, how long workers could go without getting another flow of income into their accounts before their accounts would fall to zero. So if I just take a copy here of consumption by workers, I'm going to say that's proportional to the amount of money they have in their deposit account. So where's the deposit account for workers? That's here. That's their net worth. So I copy that, and I'm going to say that the amount that they consume is proportional to the amount of money they have in their net worth account. So what I can do here is define a Greek character. If I type the / key and type TAU, the program knows that to convert that into the Greek letter tau when I press the enter key. Then I'm going to type underscore and curly brackets, which says make all the following stuff subscripted. And I've now created a time constant for workers' consumption. And if I now put the divide key here, my argument is the amount of consumption workers will do is going to be proportional to the amount of money they've got left in their accounts right now. And the value of that reflects how much of a year they could go without running out of money. Now I'm going to say that with workers is something like 2 weeks, or say 4 weeks, say 0.08 of a year. I can vary that, change the amount they consume by varying that amount. Now, of course, I'm not saying that that's exactly how workers do consume. I'm not using any model of workers' consumption to do this. I'm simply saying if they, whatever way they decide how much to consume, it will correspond to some rate of flow of money out of their account. So what I'm trying to do in defining the behavior of the various elements in the system now is do it in a way that doesn't involve the assumptions of any particular economic theory. So I could, if I was doing a neoclassical model, I'd have utility maximizing workers deciding how much to consume or making a trade-off between labor and leisure. If I was doing a post-Keynesian one, I might talk about workers having to spend all their wages immediately, etc., etc. I'm not doing any of that. I'm simply putting a bare-bones structure in which you could explain by one theory or another. I just want to show that the structure compare the structure of loanable funds, which is what I've built up here, to the structure of endogenous money, where I make no changes to the behavior of the agents between the two. I simply change the structure of the model. So having done that to define what what consumption by workers is going to be, I've got to do the same for all the other elements in the model. And since that's going to be a repetition of much the same process, I'll do that off screen and come back in a while with all those various elements defined. Well, here's the complete loanable fund system now with all those various flow elements defined. There's the rate of interest on loans being calculated as I showed earlier in the video, and all the other elements are following the same sort of idea as I showed for consumption by workers, of showing that there's some rate at which workers consume based on the current amount of money in the system. Now, in this model, I have the level of lending depending upon the residual funds in the deposit account of the consumer sector, because that's the sector that's doing the lending. So I've got some rate at which they're lending depending on how much they've got left to lend, and I've got repayments based on the amount of debt that's outstanding and so on. That's just simply saying that if you actually had the loanable funds vision of a patient person lending to an inpatient person, then the amount of lending they could do would be dependent upon the amount they had left over that they hadn't already lent out of their accounts. So that's the definition of the rate of lending there. And I have this rate of lending described as again a time constant. So I'm saying that if you take the amount of money in the consumer sector's account at one point in time and divide it by how many years would it take it to lend that money out completely, that's the current rate of flow of lending. So let's say if this was, say, 70 and this was 7, then I'd say there'd be a flow of 10 per year coming out to be lent to the investment sector. And I can change these rates of lending down here. This is using what's called a slider in Minsky. So if you put your mouse over that slider bar there and press the arrow key, you can go sideways and say, well, let's say it takes it'd be 5 years for the consumer sector to lend all its money out rather than 10. Of course, 5 is a faster rate of lending than the initial default I've got of 7. Equally, repayment taking, say, 9 years to repay the debt, it could be a faster rate of repayment or a slower rate of repayment. So you can vary those elements and see what happens to the system. And of course, the loanable funds argument is you don't really need to include the banking sector, even when they know it's there. It's just an intermediator. It has no dramatic effect upon the economy. So what I'm going to do now is simulate that and see whether those arguments are correct. I've also defined the sum of the amount of money in the deposit accounts of the consumer sector, investment sector, and workers, plus the net worth of the banks, as being the total amount of money that's in the economy. And that's worked out in calculating the rate of turnover of the economy and so on. So I'll simulate this model, and you can see that fairly rapidly the level of lending and repayment can converge to the same amount on an annual basis. We're out to a couple of hundred years of simulation here, by the way. You can see that the amount of debt has stabilized. The amount of money, which is the black line here, is flat line constant. There was an initial spike and then a flat line level of output as well. Now, what happens if we have an increase in the rate of lending? Let's say lending happens more rapidly. Well, the level of lending increases. What about if repayment occurs more slowly? Same thing. Increasing level of lending. And notice there are changes to the level of GDP as well. It'll take a while to stabilize. So it does have an impact because it alters the velocity of money by changing the amount of money in the accounts of those who spend more quickly to those who spend more slowly. I'll go back to the default situation again. And you've clearly had a dramatic impact on the ratio of debt to GDP. Here the level of debt's gone up, level of GDP has barely changed. So there's clear impacts on the debt ratio and so on, but no impact really worth speaking about on GDP. So you can ignore the level of debt unless I bring in a financial crisis like Krugman and co do in their model. But in general speaking, it's the level of debt is not important to economic activity, and banks, even though of course they exist, you can pretty much ignore them and model the economy as a non-financial system, as current macroeconomic models do. But let's just stop this model now. And notice before I do that, by the way, I'll pause it now. We're out 2,500 years in terms of simulation time because it's a very simple model. GDP is flatlined all the way, and the variations in GDP precisely match the variations in the velocity of money, because you are not changing the amount of money in the economy by lending. You're simply redistributing where that money is. Well, let's now take a look at how this is seen from the point of view of endogenous money. And that is to say, well, it's not actually a non-bank agent lending to another non-bank agent as it's shown in this model. It's a case of the bank lending to a non-bank entity. So what I'm going to do here is bring up the table for the consumption sector and say the loan is not an asset of the consumer sector. Delete it. And the lending and repayment that's shown here, they don't actually turn up in the consumer sector's account. So I'm going to delete the row for lending, delete the row for interest payments, delete the row for paying a bank fee because the bank's not going to be an intermediator. Now it's going to be an active lender in the system, and of course delete debt repayment. So I've now got rid of that vision of lending being between one type of agent and another where the agents both are not banks. Now I'm going to go to the bank's account here, and notice I've now got these 4 unbalanced entries here, and I'm going to say, well, in fact loans are an asset of the banking sector. So I click here, and then I'll say, what assets are available for me to put into this account? Well, loans are. Boom. Lending and repayment are now brought across by the program because they're still sitting there as something coming out of the investment sector, as you can see down here. So they're taking loans out from the consumer sector. I didn't delete all the entries for loans completely. And the interest payments are not balanced, so I've got to say, where are the interest payments made to? Well, they're made to the bank. That balances that row. And then the intermediation fee is just a fiction. They may well charge that in some cases, but that's not the main activity of banks. The main activity of banks is making loans, getting interest payments because of it, having those loans repaid. So that's the only change I've made to the model. I haven't even changed the motive force behind the level of lending. Of course, I should do that to be more accurate, but I want to show now, let's go back to the beginning and start the system over again and see if it's anything different to what it was with just the endogenous, the loanable funds vision, what's going on. And you can instantly see the difference. Lending is increasing the amount of money in the economy. As the loans go up, so does the amount of money. GDP is rising. I'll let it run for some period of time. It's running much more slowly once we do a reset like that. A little technical hassle we have in the software right now. But you can see that they've got rising GDP over time. So making a change to simply changing the structure from loanable funds to endogenous money has a dramatic impact upon the nature of the economy. You now have one in which the level of money grows as well as its velocity changing if you have changes in the rates of lending, and you've got a vastly different vision of the economy. If you have a higher rate of lending, if the time for lending to double declines from 7 years to 5, then you have a boom not just in the level of debt, but also the level of money and the level of GDP. If repayment takes longer, so people are hanging on to money for a greater length of time, an additional boom. If, on the other hand, banks take longer to lend, you have a decline not just in the amount of loans in the system, but also in GDP. And if we have people wanting to repay the loans more rapidly as well, that accentuates it. And you now have a plunge in GDP. Now if we go back to the original situation again, of 7 years for loans and 9 years for repayments, then you're back on a growth path once more. But in the meantime, you've had a debt crisis. You've had a decline in the level of GDP. So there's an enormous difference between having the banks in the system and not having them. This impact of taking account of the capacity of banks to endogenously create credit and therefore change the level of economic activity is a vital difference between the neoclassical model and the real world. And it's about time we started modelling the real world. We have to include banks, debt and money in macroeconomics.